I went to the bank recently to make a wire, and something seemed a little bit different because there was only one teller there. It was a new teller that I've never seen before, and there was a new bank manager that I've never seen before. So I sat down with the bank manager to make my wire, and for the last couple of years, I've been asking every so often at the bank, how is the housing market doing? Are people still buying homes like crazy? And so I asked this new bank manager, because I've never seen her before, the same question. I asked her, are people still buying homes like crazy? And she said, yeah. But there's a little bit of a dip in the housing market, so people are slowing down, but people are still buying homes. So I figured that was an interesting answer. So I continued to press her on it. I said, what's the mortgage rates at nowadays? Like, what's the 30-year at? Is it past 6%? And she was doing the paperwork, and she looks up and she goes, yeah, I'm sorry, it is above 6% right now. And I go, oof, that's a lot. And I just started to kind of like act dumb and kind of keep poking at it. And she goes on to say that the mortgage rates are so high that it doesn't make any sense. And so I figured that was interesting. And so I said, you know, if I was looking to buy a home, do you think mortgage rates are gonna fall anytime soon? And she goes, if you had to ask me, I would say, yeah, I think mortgage rates are gonna fall in 2023. I figured that was an interesting answer. And so I continued to start pressing my friends and people that I know that work in the real estate industry, because I know a number of real estate lenders who work at some of the big mortgage lenders here in Detroit. I know some of the major realtors here. And I started asking a lot of people about the housing market and interest rates. And interestingly, when I talked to the lenders, every single one, like literally every single lender that I talked to said that they expect interest rates to fall in 2023 because they're seeing a dip in the housing market. Mortgage lenders have been laying people off like crazy because people are not buying homes, they're not refinancing homes like they used to because interest rates are so high, and so they don't have the need for all these real estate mortgage brokers. Same with the realtors that I talk to. The realtors that I talk to say that it doesn't make any sense for interest rates to be this high. People are not buying homes because interest rates are so high. So they expect in 2023 interest rates to fall because people aren't buying homes. Now, this is kind of an interesting collective that I started to realize. Now, this is not a formal survey. This is just people that I know, that I talk to, that you have the bank managers, you have the real estate lenders, and you have the realtors, that all of them collectively are saying that interest rates are going to fall in 2023. Why? Not because of inflation, not because of the economy, but because people aren't buying homes. And because people aren't buying homes, we're going to see interest rates fall because they're going to have to fall to incentivize people to buy homes. Now, kind of an interesting perspective because they're saying this out of the whole perspective and interest from their business. That because my business is hurting, that interest rates are going to have to fall in 2023 to incentivize people to buy homes. That way real estate agents can make commissions again. That way real estate lenders can make commissions again. That way the banks can make bigger checks again because now they'll start doing more refinances. They'll start doing more lending. Well, at the same time, we have all these new investors and institutions talking about why the Federal Reserve Bank also needs to start cutting interest rates, because if you don't know, the Federal Reserve Bank is the entity in charge of controlling interest rates. And for most of 2022, they have been working to increase interest rates as a way to fight inflation. And increasing interest rates has consequences. Obviously, in the housing market, it's pretty obvious. Less people buy homes, less people refinance their homes because interest rates are higher, so it's less attractive to go out and buy a home. Well, you see the same thing in the stock market. When interest rates go up, it's more expensive for businesses to operate because now if you want to borrow money, it costs you more money. And if you have a lot of debt, well, now servicing that debt is going to become more expensive because the interest rate on that debt is more. And so you see stock prices get hurt because now you keep raising interest rates as a way to slow inflation. But the consequence is people stop buying homes, businesses start to suffer. And at the same time, we have inflation that is very high. So you have inflation that is still very high. Is it off of its highs? Yes. But it is not anywhere near where we need it to be. The Federal Reserve Bank says they want inflation to be 2%. So you have inflation that's very high. And at the same time, you have an economy that's slowing. The housing market is slowing, the stock market is slowing, people are starting to lose their jobs. And in the middle, you have the Federal Reserve Bank, which is controlling interest rates. And now the Federal Reserve Bank is still saying that they are going to do whatever it takes to bring inflation down. Again, what does that mean? They're going to do whatever it takes, meaning they're going to raise interest rates as aggressively as they need to bring inflation down. And so if they stay true with their word, because there's a chance that they don't stay true with their word, but if they stay true with their word, that means that they're going to continue to raise interest rates, because the Federal Reserve Bank recently came out and they said that not only are they not going to start cutting interest rates in 2023, they're going to continue raising interest rates through 2022, probably into the beginning parts of 2023, and then keep interest rates there. That means if you want to buy a home, well, according to the Federal Reserve Bank today, mortgage rates will be more expensive in 2023, and then mortgage rates are going to continue to stay high. Now, of course, this could potentially change, and I know I keep saying that because if we see a major recession, if we start to see some sort of domino start to fall, you could see the Federal Reserve Bank change course and do something completely different. We saw this happen in the United Kingdom. I made videos talking about what's been happening in Europe, but as of today, the Federal Reserve Bank says that they don't want to do that. They say that they are steadfast, holding steady to bring inflation down. If they stay true with that, well, that's going to hurt the housing market even more. That's going to hurt the lending market even more. That's going to hurt banks even more. And this is where you got to understand that if the Federal Reserve Bank does stay true to their word of bringing inflation down, that's also going to hurt stocks more. It's going to hurt businesses more, but it also creates more opportunity. Now, of course, these are things where it could change very quickly. And this is why you want to stay up to date on what's happening. And if you're looking for an easy way to do that, you can join Market Briefs, which is my free tool. It's a free financial newsletter that I created where every day my team is breaking down what's happening, not just in inflation and interest rates, but also the global economy, also the stock market, also the real estate market, also cryptocurrency, into a fun, witty, and entertaining newsletter that I promise, even if you don't have a financial degree, you're going to understand what's happening, you're going to feel educated, and you're going to enjoy reading it because we make the newsletter so much fun. So if you have not joined Market Briefs yet, it's completely free to do so, and I'll put the link to how you can join down in the description below. But this is where I want you to understand that it doesn't make sense for you to try to fight the Fed, and it doesn't make sense for you to try to predict what the Fed is going to do because, well, we can make guesses about what they're going to do. There's no way to know until they do it, and by then, if you're making your decisions based off of what the Fed does, it's too late. Now, what do I mean by these decisions? These can mean investment decisions or career decisions. On the investment decision side, you have a lot of traders, and I am not a trader, I am an investor. I'm not a good trader because to me, trading is gambling, but you have a lot of traders that bet their money based off of what the Federal Reserve Bank is going to do. You have a lot of traders betting that the Fed is going to start cutting interest rates and start stimulating in 2023. What would that do? Well, that would push more money into the markets because inflation causes stock prices to go up in general. Are there exceptions? Yes, but in general, when you see more inflation, more money printing, more stimulus by the Fed, that's good for stocks. And so you have a lot of traders betting that the Fed is going to do that. Well, if the Fed doesn't do that, all you traders are going to lose money. And this is where if you're an investor, you're not trying to time the market for 6 months or 9 months. You're investing in strong companies that you believe are undervalued for the long term because now you want to invest in the actual asset. You want to own the investment for the long term. And these little fluctuations with interest rates and inflation don't matter over the next few years. You're investing for the next decade or 2 decades or 3 decades. Then when it comes to your career, look, just understand that these interest rates could stay high for a while. If inflation continues to stay high, which it looks like it's going to be staying high for a while, you could see interest rates stay high for a while. And this is where you got to understand how you can recession-proof your business. Because I am a licensed realtor, and I know a lot of realtors, and I know a lot of realtors made a ton of money in the last couple of years. And this is where you got to understand, you got to also protect your lifestyle because what happens, and I know this because I know a lot of licensed realtors, I know a lot of licensed lenders, and when you're in this type of commission game, sometimes, not everybody, but sometimes you get into this trap of when you start making more money, you start living a lot bigger. And I know a lot of lenders who started making huge commission checks, along with realtors, making huge commission checks over the last couple of years. And so you might have started upgrading your lifestyle, started living a lot bigger because you were making a whole lot more money. Well, now you kind of see this little lull in the markets where things are slowing down. And this is where you got to understand, okay, can your lifestyle support you if things were to stay slow like this for another 12, 18, 24 months? And if not, the first thing you want to do is start changing your lifestyle. Make sure you live a lifestyle that you can afford because you don't want to be one of those people that becomes a victim to the system that you started expanding your lifestyle so much thinking that the 2020 and 2021 boom was going to last forever. So you started living a life based off of the 2021 boom and now you're facing the consequences of that. I mean, we've seen companies do that. Look at Peloton. Peloton thought that the pandemic non-gym boom was going to last forever. Their company stock soared. And then came 2022, people started going back to the gym, and the Peloton company, from a financial standpoint, essentially collapsed. You saw their stock price fall by like 90% off of their highs. And so investors in Peloton, who thought that the pandemic boom would never end, are now paying the price. And this is where now you want to make sure you're protecting yourself and understand all the things that are happening in the economy, understand what the Federal Reserve Bank is doing, and not just assume that something is going to happen because something is not working in your favor right now. Could the Fed cut interest rates? Sure, but there's no way to predict that. And this is where you want to make sure that first, you're taking care of your lifestyle, you're living within your means, and second, you know how to find opportunities that might come your way. Booms and busts happen. Real estate is cyclical. The stock market is cyclical. These things happen, and this is why it pays to be a long-term investor, because sure, the traders can make a lot of money in the short term, the flippers can make a lot of money in the short term, but over the long term, the investors are the ones that always win, and this is where you want to understand what's happening. That way you can make the best decisions for you and your money. And of course, if you want to stay up to date, you can check out the videos on my channel, but also join Market Briefs. It's a free resource that I created for you. Remember, the Federal Reserve Bank wanted to grow the economy, and they weren't worried about inflation in 2021 because we were coming out of the pandemic, and so the Fed wanted to see the economy grow, and inflation wasn't an issue, so they kept interest rates artificially low. That way people could keep buying homes, that way we could keep seeing growth in the housing market, and could keep fueling this bubble in our economy.